Hello, everyone. Welcome to another episode of Coffee with Kelly. Today, my guest is Mike Bergmann, who is a sales manager with Loan Depot at our Fort Myers office. And he is our person who knows all about the down payment assistance like the back of his hand. So I thought nobody else perfect to discuss what's going on with that and with the new Hometown Hero that's being rolled out as of July 1st. So, Mike, can you go ahead and give us a little bit about your background first before we get started?
I've been in mortgage lending for about 13 years now. I'm from New Jersey originally, live in Fort Myers. It's been a great 13 years where we've gone through refi booms to now down payment assistance is really one of the best things that we have that can help homeowners that otherwise weren't able to save and still earn a decent income and still buy a decent house with these programs. So I've kind of taken on ownership of those programs to help homeowners get in there.
And we're very grateful that you have. I know I've always, when I have questions, hey, Mike, what about this? What about that? We actually have a group chat where we all go on and talk about it. But what people don't know about Hometown Heroes, what people don't realize about down payment assistance is there are a couple different programs. One of them is the Florida Assist program. Can you talk a little bit about that program and the advantages?
The Florida Assist program has been around for a lot longer than Hometown Heroes. Hometown Heroes has only been around for about a year and a month. But the Florida Assist program, also called the Florida Bond program, has been giving $7,500. Now it's $10,000 for as long as I know, as far as in my career. It is a little more restrictive. It is considered to be a bond program, and there's two different versions of that. And it's either a bond program or a TBA, or what we call it, the bond alternative. These two programs kind of branch off into two different directions, but both provide assistance for homeowners. But the bond programs typically are more restrictive on the purchase price. They're restrictive on the income and the type of income that we use. When we approve you for a loan, sometimes we'll omit an income because we don't need it, or it's difficult to document, and we're still getting you approved. In the bond programs, though, we have to use the entire household. So if you have grandma who still earns Social Security but lives in your household, technically she will be involved in the household income calculation. She won't be on the application, she won't be on the mortgage, but the bond program requires us to add any additional income in the household. So across the board.
Same with children living in the home that are over 18. We have to use their income.
Correct. And you need 3 years tax returns, which sometimes can reveal, a program that or a past, if you are a realtor or you closed one deal last year, that'll be revealed on those tax returns. And really the reason we need those 3 years tax returns is just to identify that you're not a previous owner of a home in the last 3 years. So it can bring in more details to an underwriter or to the program that can result in some extra problems. So it's one of those things that when we go into the bond program, we want to be fully sure about every little aspect of our borrower before we get into contract to make sure there's nothing that's going to come up on that 2020 tax return.
One thing I do like about that bond program, because it's something that we've had available to us, is a lot of times our buyers are getting an FHA loan with a better interest rate than they would have on an FHA loan and with no points. However, on the flip side of that, there is an origination fee which could equal the points that they would pay on FHA.
It literally is 1 point.
Yeah.
So that fortunately, though, is going away effective July 1st.
Oh, that is on the Florida Assist. Okay.
The program right now, if you were to initiate a transaction today and you were to buy a $200,000 home and you would get $10,000, but right out the window, 1% of your loan amount, let's assume it's $200,000, means $2,000 goes out.
Okay.
But there are other benefits in there as well,
yes,
because you also will be waiving the intangible and mortgage tax, which
yes.
otherwise would be on all other transactions, and that is 0.55% of your loan amount. So in that same scenario there, that's $1,100. So you give away $2,000, you get back $1,100. You put that into the whole transaction there, you're still getting a decent amount of money. But effective July 3rd, which is when you can lock it in, it's the first business day, that money will be, that for 1% charge is going to be removed. So you're still going to get the benefits of removing the intangible and mortgage taxes. You're still going to get the $10,000, and you're still going to get the lower rate, but you're not going to have to pay that fee. So it definitely expands the benefit of it. And we usually like to use this type of program with condos, with lower priced homes, because that $10,000 goes a long way. Now, some of that is going to be counteracted here with some of the changes in the Hometown Heroes program.
Okay.
But initially, at least, we like that program for those lower cost homes because it makes a big impact as far as the percentage goes.
Right. Awesome. One program that I do want to hit on real briefly, only because it's not available right now, and Mike and I are both on the preferred lender list for the state of Florida for these programs, and I'm sure he gets calls like I do, and clients find the Lee County Own a Home program, and right now it's not being offered, and trying to explain to somebody why that's not being offered. But just briefly, can you touch on that program, when it is available, the benefits, and why it's not available?
It's important to define the difference in these programs. The first program we mentioned there is a bond program. That means that $10,000 needs to be paid back. It's going to be paid back eventually. It's not going to be paid back in your monthly payment. You're not going to get called up and say, hey, you need to pay this. It's only to be paid back when you sell the house or you refinance. And most people doing a transaction today are going to refinance in the next couple of years.
Yeah.
But then we also have a forgivable grant program, which I'll just touch on briefly here.
Yeah, just briefly.
Which it gives you the money, and then for each 1 year that goes by, 20% of the money that was given to you disappears. But you have to stay in the mortgage for that long. You can't refinance beforehand. And for every 1 year and 1 day, it goes down by that 20. And by the 5 years, it's gone. And then lastly, in this grant program, it's full out grant. You're not going to have to pay it back. And, if you're thinking about how are we giving away this money, well, it gets added into the rate. At least that's what I believe, based on what the actual rates show here. The bond programs, we could be at 6%, we could be at 6.25% on FHA loans, we can be in the mid sixes on conventional loans. But when we start getting into the forgivable grant and the grants, they go way up into the sevens, mid sevens, and eights. And it's one of the reasons why, and the grant program really is not even available right now, because all the funding is going to these bond programs, which are going to be replenished. And then as a result here, we don't even see the forgivable grants at all because nobody wants a 7.5%, 8% rate.
Correct.
It's not worth the money.
Correct. So the big deal that's happening July 1st that everybody's talking about is the Hometown Heroes. Now, Hometown Heroes came out last year, was restricted to just certain types of occupations. Now the state of Florida, and I've heard that our PAC was instrumental in getting this set up so it's for all Florida businesses. So what's changing? What's going to be available?
Okay,
let's hear about it.
We were given $100 million here for this program last year, starting on June 1st. And it was restricted to actually many professions, but you had to be licensed with the state. So there were a lot of professions that were considered to be healthcare, but just weren't involved in that. They really were like registered nurses, any type of medical profession that required a license, law enforcement, veterans, first responders in general. So there was a lot of people, all the way down to massage
people,
So there was a lot of people there, but you really had to be registered with the state. So the $100 million actually just ran out about a week ago.
Right.
And we're all kind of in limbo waiting for the new program, which really goes under the title of Live Local. And we're still calling it the Hometown Heroes program. It still is, but now the definition of what a hero is now you work for full-time, 35 plus hours for a Florida business, or a business that as a brick and mortar in the state of Florida. There are still some questions as to how we are going to determine who a full-time person is when it comes to self-employment. So there are still questions there as to what's going to be cleared up by the Florida Housing Finance Corporation. They basically say that we have to figure out how you are full-time. If you're a realtor, for instance, how do you say that you're a full-time realtor? How do you put that on paper exactly?
Income threshold that has to be met, and then there's income restrictions.
We have to define you as full-time, which and I think they're going to have to do quite a bit of explaining as to how we're going to do that. But right now, if you work for a business and you work 35 plus hours a week, at least one person on the application has to have that. This does exclude people who are retired, on disability, that are receiving passive income sources. So, that is something that, was not present in the first program either. So it wasn't really a change per se, but it does exclude those classes of people.
So, Michael, can we talk about the different fees that are going to be involved? Because that's changing too, where before, like you said, the 1%, there's a $400.
Well, I can clarify
here. Clarify, please.
There are no actual fee changes on this program this time around here. And that's because the Hometown Heroes was born without any of those additional fees that we mentioned earlier that were included on the bond programs. All of the bond grants, forgivable grant, all these programs had a 1% of the loan amount fee that was required in all past existences of these programs here, at least during the time that I've been using them. And what was really evident with the Hometown Heroes was that they were not going to charge us for that 1%. And that's really huge because the Hometown Heroes program deviated from all previous programs because usually we were restricted to in the 350s, 400s or so as far as the maximum. The Hometown Heroes jacked that all the way up to the maximum conforming limit, which is $726,200. So that amount, if you start adding in a 1% fee for that, it gets pretty hefty in that respect. So those fees were entirely gone. It once again waives the intangible and mortgage tax, which is 0.55% of your loan amount, quite a bit. You're going to pay that no matter what. In any other type of loan program, you're not here. And also, since there is no 1% fee, how many transactions are going through right now that have at least 1 point on them? The majority of them.
Almost every one of them are.
If you get a 1% discount point on a loan, then you are getting out okay.
Correct.
As opposed to many others that are paying 2 and even 3 points in some cases. This has 0 points. So it's a huge swing from the average deal of 1 point plus the 0.55% of the taxes that are included here. That's 1.55% additional that you're getting on top of the 5% that you get for the program. So you're getting a minimum $10,000, a maximum $35,000, but ultimately it's going to be 5% of your loan amount. Now, the headline number will be $35,000 out there.
Right.
And people will probably call me up and say, I'm going to buy a $200,000 house, and I'd like the $35,000, please.
Yes.
It's not going to happen. So that is the absolute maximum. That is basically a $700,000 house. Right now, I have one transaction that's going through that we're using the max $25,000, and even that, it's difficult to get someone that makes enough to be under the limit and still qualify under the parameters of the program. So don't worry about the $35,000. Let's just find the house that you can afford, and let's use this program because it'll do its job.
Now, is there a restriction on how much the loan can be?
Well, it really goes to that conforming limit. So there's FHA, which is the maximum FHA, which deviates based on the county, but for the most part in Southwest Florida here, it's around 470 or so.
I think so.
Forgive me, I don't have the exact number right now, but it's around 470 or so. And for the conforming limit, though, for conventional loans, that's 726 too.
Yeah.
So that you have to make $128,000 maximum in Lee, Charlotte, and many counties in the state. And then you're going to afford a $700,000 house, probably not going to happen.
Right,
You're probably going to be
exactly.
something a little more modest than the 500s or so. However, there are other counties like Collier County, which we find that you can't even find a house for $500,000 in many cases, and they have a much higher income limit. It's around 150 or so, and we can check back on those exact numbers here. But for the most part, yeah, Collier County is 149.
149.7.
Yeah.
Yep.
So, so those are limits that are much more in line for those counties, because you do need to make that kind of money in order to afford most of the homes that are there. And that's one of the other beauties of this program, is that it does match each county for what the everyman is going to need to be able to purchase a home that is not extravagant, but not impossible to find either.
Yeah, I'm looking. I have the list here of the allowed incomes, and like Broward County is 144,000. Dixie County. Oh, I don't know why I went to Dixie County, but anyway. But yeah, there are other counties on here. I was going to see if West Palm or Palm
There are
Beach
definitely
is
certain
on there.
counties
Yeah,
here.
146, 100. Yeah.
There's definitely some counties here that if you make the maximum here, you
Yeah.
are a rich, rich family.
Yes, you are.
In Florida. But there are other
Exactly.
counties that you are struggling to get by in that situation.
I go back to my son. He lives over in Boca Raton. He has a condo over there. He's got a great job with the city, but for him to move on, the home prices are out of his range. He would have to move to another county. So yes, it's all relative to where you are, and it looks like they've adjusted these incomes accordingly. Let's talk about debt to income. Consumers out there, you hear this all the time. What's your debt to income? Debt to income restrictions on this program, and credit score restrictions on this program.
So there's a difference between what the restrictions for the program are and what you're actually going to get approved for.
Yes.
So, if we have a client that is a 679 credit score, in almost all circumstances, we're going to direct them to the FHA part of the program.
Yes.
Now, the FHA part of the program is a lower rate than the conventional one. It is effective in March of this year. They reduced the mortgage insurance rates on there by 30%.
Yes.
So right now, FHA is falling right in line with what a 720 credit score person would get on a private mortgage insurance. So in many cases, I have good credit people. We're still going in the FHA direction.
Yes.
But lost my train of thought there. Was
That's okay.
question-
He can.
I'll cut it.
Debt to income and credit score.
So as far as the credit scores there, we do have to count in what is actually going to get approved. So the difficulty in going with a conventional versus an FHA mortgage is that conventional is going to have more difficulty getting approved with less than two borrowers. So if you're only a single person and you have that same 679 credit score, I'm probably going to have some difficulty pressing our little button there, which comes up and says green approved, or rework this application. And so if you're buying a condo, you're not going to be able to use FHA in many cases.
No, you're
I would
not.
say in 99% of cases
Yeah.
there. So if you're trying to be that modest buyer of that $210,000 condo and you're just a single person and you have a 679 credit score, we would want to ensure that works in advance, because the credit can be sensitive in a conventional loan. Now, on the flip side, though, if we have two borrowers and we get the same 679 credit score, we have a much better chance. Something about the system, just if we have two guarantors on there, it's much more likely to work out.
FHA just likes that scenario a little bit better. Something else I want to mention, though, if condo, but they could buy a townhouse, or
yes.
a villa, as long as it's set up with a homeowners association, not a condo association.
And we can check that for you.
Yes.
Or any. Essentially, the difference is a townhouse, you own the land.
Yes.
Condo, if you see them stacked, definitely a condo.
Yep.
But if they're lined up in a row, then it's kind of iffy.
Yeah.
It's about, it could be condo, it could be a townhouse. But
Yes.
If you own the land, then you can find that through the county property appraiser website. A lot of realtors, though, will misclassify as condo, villa,
Yeah,
townhouse.
you really need to know
so
what governs
we
it.
know the difference for sure.
It definitely. Question for you: can you have a co-signer on these loans?
You can have a co-signer. Now, there's a differences in how that cosigner is done. They're called a non-occupant cosigner.
Yep.
They are not allowed to be on the deed. They are not. They are allowed to be not allowed to be on the contract even. We will only process them as a person on the note. They are stating that they promise to pay. They are involved in the transaction. They do count into the income limits.
Oh, well, yeah, that would make sense.
So, if you have rich Uncle Johnny who makes $400,000 a year, probably not going to help you with this program.
No.
You should probably just ask him for a gift.
Yeah, exactly. Exactly. But if you needed that second person on there to make that FHA work, again, you're going to want to be careful what their income is before you go asking.
Absolutely.
That is really awesome.
Now, as far as the DTI.
The DTI, yes.
So when we calculate your income here, we don't look at what pops in your bank account. We look at your gross income. And you probably have multiple line items on your pay stub. If you have bonus, if you have commission, if you have piecework, if you have just hourly work that, you have 35 hours this week, you have 45 hours next week, you have 30 next week. We look at all of that and we actually break it down into each subject there. So we're going to take that income and generate your qualifying income is the term we're going to use. And this does not have household income like we talked about earlier here. This is just simply what we are inputting in the application. So let's say you're at $128,000 salary flat and you got a $50,000 bonus. Technically, we only need to use the qualifying income. We don't have to go back and make sure that bonus is continuing. We don't have to put it in the application. So there are certain ways that we can help these, for those that might have that income source that they may not necessarily trust going forward, to put that in the application.
So we don't have to put that on the household income for the
bond. Yes, we do.
So, but for qualifying, we may not always be able to use that. Something I've gone to doing is asking my borrowers that do get overtime commission, tips, things like that, is for their last pay stub from 2021 and the last pay stub from 2020, so that I can break it out, because the W-2 is not going to.
Yeah, and if you just got a whole lot of overtime this year, but you got zero last year and a whole lot in 2021,
we can't use it.
We got to have consistency.
Yeah,
so
exactly.
Ultimately, the maximum back-end debt ratio, and what a back-end debt ratio is we take your housing expense, let's just say that's $2,000, and let's say you got a $500 car and $200 in credit card payments. That means we've got $2,700 is your back end divided by whatever your gross income is. Yes. So the maximum there is 49.99%. So we can't go over 50 there. There are certain situations I'm not going to get into.
No, that's not going into that.
But as far as the back-end ratio, it's about 49.99. On a FHA deal, typically we can't have a housing ratio of more than about 47%.
Yes.
Conventional deals, it varies. So we can be in there. If you have really good credit and we have reserves, and we may be able to expand that up into a higher debt ratio. But the thing about higher debt ratios also means that private mortgage insurance goes up too.
Yes.
So it's a moving goalpost situation. And
yes.
Every client pretty much needs to, if you're going to be in this high debt ratio area, what I recommend is as you're searching for properties, that we analyze each property that you're serious about to make sure that we don't have unexpected flood insurance, right. Just getting a quote on the house itself, just because homeowner insurance is so much more difficult these days. And then get the correct taxes. And if you're buying a new construction property, no one's really going to tell you what the taxes are. We have to kind of concoct that using the county tax estimators or new purchase estimators that we use on our side.
And we usually base that off the
purchase
sale
price and the millage rates.
Yes. So going to that construction piece, not to interrupt you, but sometimes what we calculate is probably higher than what you're going to pay. If you go back and look at my episode 2 where we talked to Paul Polk, how that's estimated. Go ahead.
So that is sometimes the most difficult part for you as the buyer to understand is, what's my payment? And you go on Zillow, it's based on a 20% down payment. I've seen rates that are like 5% on there that, where they even put these.
Some of the insurance premiums they come up with, I'm like, no.
maybe not new construction, with minimal coverage.
Not in Florida.
But a lot of those numbers, unfortunately, are very off. And we operate in this day in, day out. We're seeing the properties. We're seeing the insurance, the quotes that come in, the good ones, the bad ones. We're going to be able to at least fairly accurately tell you what your payment is, plus or minus $100 or so, depending on the insurance. Insurance is getting more difficult, so you do want to know that you're going into this transaction at a 49.8 ratio here, and we're on the sales end. We're optimistic people. We have to combat with the backroom person, the underwriter.
Yes.
And the underwriter, their job is about mitigating risk. And so they may, in some cases, look at your income and say, well, I'm going to take the bottom number. And we have to make sure that we're going in that transaction and there's potential for that bottom number there, that we're prepared for it and we can still get approved with that number, even if we're going to be really optimistic about your income.
Right, exactly. Mike, we are about out of time. Thank you so much. I mean, you and I could probably sit and talk for an hour and give these
This is what I do every day.
Yeah, exactly. A lot of advice. My parting advice to you is, if you are a home buyer or getting out in the home buyer market, number one, find a realtor, stick with them, listen to them. Find a lender, stick with them. Do not listen to mom, dad, aunt, uncle, cousin, brother-in-law, because they don't do this on a daily basis. And if they get an interest rate, my biggest thing is, my interest rate was, my brother just got, 5%. Well, does your brother have this kind of credit, this kind of a down payment, things like that? Not trying to offend anybody, but these are just the hard realities of it. Michael and I are in this every day. So please find a trusted professional and stick with them and listen to them. Thanks everyone for tuning in.
I do have one more thing.
Oh, what's that? Yeah.
I just want to give you a quick tagline of what Hometown Heroes means. It means that if you were to purchase a home and use this program, in most scenarios, you'll be able to purchase a home for, depending on how you negotiate your contract, for $0 to $10,000, all the way up to $600,000 or so.
Yes.
So almost all my transactions are getting done with less than $10,000 out of pocket. I would say that you'd want to have at least 5 for most transactions, but that's a pretty great deal, considering that if you want to rent someplace, you're going to have to pay a first and last month rent, and you're going to be around $5,000.
Yes.
And that's my biggest tagline there.
Thanks again, Mike, for coming in. And again, tune in next time for more information about our area and home buying. Thank you.